Hello and welcome to Pro Trader Strategies market commentary for Friday, February the 21st. I'm Eric Wilkinson. Yes, you may recognize me as the Wolfman from mainstream media, where I've talked about economic, geopolitical, and then market analysis. Well, I do that same stuff in these daily market commentaries where I talk about the economic data, the geopolitical environment, and how that's going to overall impact the markets. But I layer on top of that some option strategies that I find that I want to implement into my portfolio and talk about some rules that I have in and around options trading before we implement those strategies into our portfolio. So please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, let's get it on with the economic data. It's a pretty busy day for data and some, yesterday I did this video, and immediately afterwards China came out and said there was a lot more coronavirus than earlier detected. So that really sent the markets into turmoil for a little while. We did rebound, but today seeing some more weakness flush into the markets. So let's talk about the economic data and how that's impacting the overall markets. Pretty decent PMI numbers. So across the pond, we get the flash PMI numbers. That is the most important number for them. Ours is in the Institute for Supply Management, despite the fact that we get our own flash PMI numbers. So let's talk about that anyway. Across the pond in France, we got their flash services PMI, which is Purchasing Managers Index. This is forward looking. That's why I find it the most important economic data point. Expected to be 51.4, came in at 52.6. Anything above 50 is expansion. Anything below 50 is contraction. France, Germany being the manufacturing sectors of the European region. So we got the French flash manufacturing PMI coming in at 49.7, expected to be 50.8. So a blip back below. We've had about 6 months in a row above 50 showing expansion. But now we get this blip below, so that's not a great thing. That's showing contraction. We got the German manufacturing PMI coming in at 47.8, which is higher than the expected 44.4, and last month's number was 45.8, so making some comeback here. That is one of the better levels we've seen since basically 2018, so that's a good thing. They've been showing recessionary for all of 2019 and up until this point. So trying to make a comeback there. Then we got the services PMI for Germany coming in at 53.3, expected to be 53.9, so slightly lower than expected there. Greater European region for flash manufacturing PMI coming in at 49.1, just slightly below that threshold, expected to be 47.4. Again, that they've been in negative territory all of 2019. The services PMI coming in at 52.8, expected to be 52.4, so better than expected there. And Great Britain's flash manufacturing PMI coming in at 51.9. That's gotten back above where they were expected to show some contraction there at 49.7. So they stayed above 50. It was 50 last month as well. Services PMI coming in for Great Britain at 53.3, expected to be 53.4. Upward revision to last month's number by a point to 53.9 from 52.9. All right, here in the United States, we got our own flash manufacturing PMI that came in at 50.8, so it's above that threshold. It was expected to be 51.5. We've seen 6 months in a row of that being above that line of delineation. Although services sector did dip below 50 at 49.4, expected to be 53.3. So that was one of the bad PMIs. Usually our services PMI is almost always above 50. It's the last time we saw a negative reading was in 2016. So that is a bit of a shocker. And we got existing home sales coming in at 5.46 million units. I would expect to start seeing some of these, despite the fact that we are in a winter month, that we're going to start seeing some home sales start to move higher. We've seeing the bonds, I talked about it yesterday, going below 2%. Well, they are actually at 1.8 6-ish or below 1.9. So if we get a settlement below 1.86, we are going to see historical lows, all-time historical lows in the 30-year bond. We're also looking at 2 to 10 inversion, yield curve inversion, which signals recessionary or lower rates way down the road in recession. So right now we got the 10-year, it was hovering somewhere around 1.45, which is basically, there's a double bottom there from 2012, 2016, and we used to say on the floor, third time through. So we could see that go through that double bottom that we saw in 2012 and 2016. So keep your eyes out for that. All right, we've got crude oil coming off a little bit as we would expect. The equities are coming off. This is showing with this yield curve inversion, we're showing that recession is down the road possibly. And that's causing gold to spike here. As people are throwing their money at the safe haven in gold, that's hurting my GLD position, but I'm going to hold on to it a little bit longer. These are the lowest levels we've seen since, I think it was like 2000, pulled it back to 2000, and let's just take a look at it. I think, so we're right now at 1646, so we can just draw this back on a 20-year. So 16, so we're looking at 2013-ish areas, as you can see here. The all-time high there at 1923, but gold really seeing some moves higher here. And bonds, as we can see, are moving higher. Now, the yield is lower than what we're seeing here on the pricing, which is a little bit of a misnomer sometimes. But we look at, as the interest rates are going down, we see the bonds going up. It's that teeter-totter effect. It's not always necessarily perfectly correlated there, though, as in price and in yield. We got the VIX spiking. We were into the 18 handle. We're seeing a little bit of that come off as equities are trying to make a little bit of a move here. We can see the Dow Jones Industrial Average off 240 points, but off of the lows of the day. NASDAQ, semiconductors, and these chip makers are really driving this market down. As a matter of fact, when yesterday came out, we've been talking about Apple having production and distribution disruptions and things of that nature. The iPhone 12 maybe not being able to be produced in mass quantities like they would expect for this April or summer release. That Apple kind of held its own weight through that, whereas Microsoft, which doesn't really have exposure to China so much, really got beat up yesterday. And we're seeing the semiconductors really get crushed on this news from China. So NASDAQ down 107 points. Yesterday NASDAQ was leading the way to the downside. It's probably in percentage terms leading the way to the downside again today too. With the E-mini S&Ps down almost 20, right now down 26 points on the day, but again off of the lows. I was celebrating the fact that we rallied and got back above that 9-day moving average, but today we opened up and sold off. We are well below that. I doubt we are going to be able to get back above that 9-day moving average today, so that is going to be signaling some short-term bearishness and possibly a retest of this 3266 area coming up shortly. So keep your eyes out for that line of delineation. You can see here, yesterday we made that nice move to get back above that 9-day moving average, but soon as the market opened overnight, we got weakness, and into today, just no chance of trying to flush those guys out, which is really pretty bearish, as I've talked about. If you don't try and flush out the overnight inventory, whether they be long or short, that it is a continuation of that trend. So this being bearish, it is a continuation of that going forward. All right, GLD, this is what I was talking about, this spike higher. This is also the highest levels GLD seen since 2013, which is kind of ridiculous when we're considering the equities being at all-time highs. I don't think that the economic data is that bad. The coronavirus, yes, it is probably going to start digging into some of these earnings going forward. So maybe equities are a little bit frothy then at that point, but is it really going to send us into a recession or a long-term drought of economic activity? I don't think so. I think that gold is still overpriced. With these levels, I'm up there at the 157 handle, so my position is looking terrible today. But look at that gap. It just gapped higher. So I'm hoping we get a move back down and cover that gap. I might look to cover that trade relatively quickly if that happens. So, not loving that trade at all. All right, well, with Microsoft, I did get out of this. They're getting beat up. It settled below the 9-day moving average. I decided to pull the ripcord on it. Lost a little bit on this trade. If you guys remember, I had on the March, I had sold the 180 puts in there and then bought the 175 puts for that put spread. Did it for last week's webinar talking about that. I thought that, Microsoft would be a little bit more isolated from this coronavirus. And I still believe they are, but, the market can remain irrational longer than we can stay solvent. So I decided to get out of this. And I got an original credit of $1.60. I bought it back for $1.95 this morning. So I'm out of Microsoft on my bullish trend there. So, that's about it. That's all I've done. I haven't covered anything else. Not even looking to cover my Disney short calls right now. We're starting to see some volatility move a little bit higher there. So despite the fact that it's down on the day, everything else is remaining the same. Might be looking to add a few more short deltas to my portfolio to take advantage of this high volatility and this move down in equities that could be a little bit longer in longer duration here, especially now that we're below the 9-day moving average. Try and take advantage of that. All right, that's all I got for you guys. Hope you have a great weekend. Stay tuned. Watch me on Twitter because I might be throwing out what trades I'm throwing on there, and just to keep you guys fully informed of that. And finally, I got to throw up my disclaimer for you. Take a moment to read over this. Past performance not indicative of future results. We are an educational company, so everything is hypothetical. All right? Take that.